Hello and welcome to this session in which we would look at stock valuation using the constant growth model. Now the first thing we would like to know is, what is stock valuation? Stock valuation is figuring out, setting a price for that stocks, finding out what the stock price is. Now hold on a second. Can't we go to CNBC or to the Wall Street Journal or to Finance Yahoo and figure out what the stock price is? Yes, we can. We can find the market price. This is what the stock is trading at now. That's the market price. However, as investors, we want to know if we are paying too much for the stock or if this stock is a potential bargain. What does that mean? If the stock price at Yahoo for a particular price, let's assume Amazon, is trading at $450, the question becomes, is this a fair price or is this a bargain? Should we buy it now or it's overpriced? Well, what does that mean? It means if we have it, we should sell it. If it's a bargain, we should buy it. That's what stock valuation tells us. So how do we do so? Well, we do so by looking at the dividend. So one way to value a stock is often tied to its dividend payment, because at the end of the day, when you make an investment, what do you expect in return? You expect cash. At the end of the day, you expect a return, and that return is cash. So one way to value how much an investment is worth is to do what? Is to discount the cash. Discount the dividend, because you will be receiving that dividend in the future. Now, I gave you a good example. I said Amazon. Amazon don't even pay any dividend. Well, how do we value that stock? Well, that's a separate story. This is not what we will be valuing today. Today, we'll be valuing stocks that pay dividend at a constant growth rate. But the point is, at the end of the day, any investment you make, even if you are investing in yourself right now, even if you are investing in your education, even if you are investing in anything, what you do is, how to value your investment? How much am I going to be getting in the future? And what you do, you take all these payments and you discount them to the present value. Therefore, the simplest way to value a stock is to look at the present value of all future dividends. Now, dividend is a fancy word for cash. Cash is, what do you get in form of dividend? You get cash. This means if you could estimate the dividend for a stock, you will know how much you will get in return, and therefore you will determine a fair price for the stock. Just like you would buy anything. If you want to buy a building and rent that building out, you will determine how much rental income you will get from that building, and you will discount the rental income. And obviously, if you plan to sell the building down the road, you discount that. So at the end of the day, everything we're going to be doing here should be no surprise, because we looked at the constant dividend model. This is going to be a constant growth. In the prior session, we looked at the constant dividend, which we will review briefly, because it's the same thing. It's discounting, finding the present value of all future dividend. So let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com.
Our corporate finance course is best for online students and students who are taking corporate finance courses. We cover financial statements, discounted cash flow, stock valuation, bond valuation, NPV and capital investment decisions, cost of capital, risk and return, as well as other topics. Our course includes lectures as well as multiple choice questions. Go ahead and start your free trial today. No obligation. We are here to help. Your success starts here.
First, it's beneficial to go back and review real quick the constant dividend. This is the easiest scenario. The company will pay the same amount of dividend forever. So let's assume this company is paying $3. It pays $3 forever. So imagine a stock paying $3 with no plan to change this rate. Now, do we have stocks that does this? And the answer is yes. Preferred stock, they pay the same amount of dividend every year. And if you keep them forever, they pay it forever. So it's possible, but that's not the most common stock. Now, what else do we need? As investors, we're getting $3 per year. Let's assume $3 per year. Is this a good investment for us? What do we look at? We look at something called the required rate of return. It means, what do we want to earn as investors? Is this enough for us? And if this is enough for us, we will discount all the payments to the present to figure out what the stock price should be, or what should we pay up the price for it. Now, for this investor, we expect 15%. Now, later on, we would look at this required rate of return, or the discount rate. It goes by several names, but what is that required rate of return, or R? R is what the investors want to earn. Usually it's the cost of equity for a company. For the investors, it's how much do I want to earn to say, well, to compensate for my risk, to be specific. So to find the price of the stock, P0, we'll take the dividend, which is $3, and we'll divide it by 0.15, the required rate of return. Why do we do so? This is a perpetual annuity. Perpetual annuity means an annuity, a payment that goes forever. Therefore, we'll take $3 divided by 15%. We will pay for this stock $20. And if we keep this stock forever, every year we would earn 15%. It's what we want to earn. Now, can you verify this computation? Yes, I am going to verify this computation to show you it works. So if you deposit $20 in a bank account, and that bank account is paying you 15 pennies, you will earn $3 per year. You will take that money out and you keep the $20. Then you would earn 15%. You'll get the $3. You take it out, you spend it, and you will keep that 20%. This is a perpetual annuity. So this is what we mean by earning 15%, because you want to earn 15%. Every year you will get 15%. Your rate of return is 15%. This is called zero growth or constant dividend. So this is how we value a stock, using having a constant dividend, which is $3, or it's called zero stocks. As I mentioned, it's perfect for preferred stock. But in the real world, the dividend rarely stay flat forever. And we explain why in the prior session, because for common stock, if a company is paying $3 per share, and you purchase the shares at $100, well, your rate of return, your dividend yield, there's something called dividend yield, your dividend return or your dividend yield is 3%. Now let's assume a year later, this company generated profit, and as a result, the value of the company, because if the company does well, the stock price should follow, and this is what we'll be discussing today. And let's assume the company keeps the dividend at $3, and because the company grew, the price of that stock went from 100 to 125. Now, if someone wants to buy the stock, they would say, well, I'm getting $3 and the stock price is 125. My rate of return, my dividend is 0.4. Notice it went from 3 to 2.4. Hold on a second. Why would someone buy a company to get a lower yield? You will not do that. So what's going to happen when the company grows, the assumption is the dividend will grow. Now, how much will the dividend grow? Well, assuming they want to keep it at 3%, the dividend yield, they'll have to take 125 times 0.03. They will have to pay $3.75 to the new investors. If they pay $3.75, then you have a yield of 3%. So if they pay $3.75, the yield will go back to 3%. If that's what the company wants to do, earn 3%. That's why the dividend will not stay the same. Now you might be saying, how about if the company went down in value, went down from $100 to $80? Well, if you buy the stock now, your dividend yield is 3.75. You will be better off. But again, you want to ask yourself, why did the price went down? Are they not growing? So on and so forth. But let's build on this idea and incorporate growth rate. So the idea is the same. The idea is to do what? The idea is to discount the future dividend at some sort of a required rate of return. But in this example, the constant dividend, the simple example, we assume that dividend will stay the same. D1 equal to D2, D2 equal to D3. And what we figured out in the prior session, that if we can do that forever, we can simplify this forever formula into the perpetuity formula, which is the dividend payment, C divided by R, the payment divided by R. Now, carrying on this concept, which is the concept of what? The concept of discounting cash, discounting dividend at the present value, we can look at the dividend growth model. So we're gonna look, all what we're doing is to find the price of a stock. We'll take D1, D2, D3, and we discount them 1 plus R raised to the first power for dividend 2, 1 plus R raised to the second power. So now we need to ask ourselves, we were assuming D1 equal D2 equal D3, so on and so forth. How about if D1 is different than D2 and D2 is different than D3? And specifically, we're going to assume that the dividend is growing at a certain percentage. Well, if that's the case, how do we compute the price of the stock? In other words, if dividend is growing over time. Well, if dividend is growing over time, here's what we do. To find D1, to find this dividend, we'll take D0 times 1 plus a growth rate. Just like we find what's going to happen if we have $1,000 and this $1,000 would grow at 5%, what would that $1,000 equal to a year from now? Well, this should be equal to $1,050. So this is how we find the future dividend. Now, let's look at a simple example. Let's assume, just because we want to know how do we compute D? So the first thing we want to do now is how to compute D. And basically, we'll take the previous D, the previous dividend, and multiply it by 1 plus G. Well, to understand, let's work a quick example. If the dividend we are paying today is $2, which we don't need to discount, it's paid today, and it's going to grow annually at 15%. How to find the dividend next year? Well, D1 equal to D0 times 1 plus the growth rate. D1 equal to $2, this is D0, times 1 plus 15, 1 plus 0.15, which is 1.15. D1 equal to $2.30. Now we figured out D1, $2.30. How about if we want to find D2? If we want to find D2, we'll take D1, which is, we figured it out, $2.30, multiplied by 1 plus the growth rate. It will be approximately $2.64. Okay, how about D3? D3 is D2 times 1 plus G, which is approximately, it's $2.64 times 1.15, approximately $3.04. And as you can see, we can go forever. We can go forever. In other words, we can take this formula and go forever to find what's P0. Why? Because we are factoring into account the growth rate. So the only difference between what we did earlier, which is the constant dividend, and this one is the dividend is changing. Now, if the dividend is changing, now we have to go to find the price of the stock. We can go forever, basically, right? Because the stock theoretically is forever. It lives in perpetuity. Now, obviously, you're saying, hold on a second, don't we have to also discount the stock price at the end? Well, yes, you have to discount the stock price at the end, but the stock price, we are assuming it's a factor of the dividend. Also, we could also make the simple assumption that the stock price forever, the price of the last, if it's forever, it's technically zero. So that's why we drop it from the formula, but it's still there. Now, we can take this formula that goes forever, and we're going to simplify it. All what I'm doing now is simplifying the math. This is a geometric series with a common ratio of 1 plus G and 1 plus R. 1 plus G and 1 plus R. So if we do a little bit of math, applying the infinite series formula, we could rearrange it, then simplify it, D1 equal 1 plus R minus 1 plus G, and it will be rearranged into this formula to find P0, to find the price today. We'll take the next dividend, very careful, D1, we'll take the next dividend, be careful, this is the formula, it's the next dividend, not the current dividend, divided by R minus G. Now let's talk a little bit about R. We talked about R a little bit. R is the required rate of return. What the investor wants to invest, what the investor wants to earn. The required rate of return for the investor. It's also called the discount rate, how you discount the payment. and it's usually the cost of equity for the company. Anyway, we are going to compute R later on. In other words, we need to figure out how to compute R. But R deals with risk. If the investment is risky, you would require a higher rate of return. Now, although R don't relate R with risk, it's return, but it's a measurement of risk. That's R. We'll talk about that later. G is growth. Well, the company grows over time. The dividend will grow over time. What do you expect the dividend to be growing at? Because as the company grows, listen to me carefully. Remember, the stock price was $100 and it was paying $3 per share, and the dividend yield was 3%. As the company grows, as the company makes more profit, what's going to happen? As the company makes more profit and the company grows, everybody wants to buy this company. Why? Because this company is growing. Don't you want to invest in a company that's growing and making more profit? Well, if that's the case, the stock price will go up. Well, if that's the case, if you want to keep a 3% yield for investors to buy your stock, you have to increase your dividend. The point I am trying to make, and I will show it to you mathematically shortly, is the growth rate applies to the dividend, and indirectly it's applying to the stock. So whatever growth rate you are saying the dividend will grow at, the stock price will grow at. They grow at the same rate. Why? Because think about it. The dividend is coming from the profit of the company. So if the company is doing better, the price will go up and the dividend will go up by the same rate. This is what we're going to be showing later. But what I just showed you is called the Gordon growth model. It's the person, Miriam Gordon, that's the person that created it. So because most dividend don't stay constant, they grow over time, and this is in the real world. This is what happens, whether it's Microsoft or any other company wants to start to pay dividend, or Cisco or Walmart or Procter & Gamble. Yes, for example, they pay dividend quarterly, for example, 25 pennies for a period of time, then they raise it to 4%, another 4% forever. They can do that. Sometimes they could change the percentage, but it's going to grow. So the formula for estimating a stock that grows its dividend, to find P0, I just showed you, equal to D1. D1 is the next dividend divided by R minus G. Again, P0 is the current price. D1 is the expected dividend, not the dividend today. So if you're giving a problem and they told you the dividend today is $2, this is D0. We don't care about D0. We need to find D1. If you are giving D4 and you want to find the price next period, you would look at the next dividend, which you want to look at D5. So be careful. So whatever the price is, so if the price is P4, you want D5. You want D5. It's the next dividend discounted at R, the required rate of return, minus G, the growth rate. So this formula simplifies things by replacing an infinite series of dividend with one simple equation. All what we're doing is you don't have to worry about the math. You have to understand that to find the price of the stock, we look at the next dividend divided by R minus G. So everything that I did on this slide is just to show you where it's coming from. But if you memorize or understand this formula, you will be good to go. But it's very important to see where it's coming from. Let's take a look at this multiple choice question from farhatlectures.com. The constant growth model is a method for assessing the value of stocks. Perfectly. It assumes the value of the stock is what? It's the present value of the next period's dividend, the present value of all future dividend, the present value of the next period dividend divided by the required rate of return, the present value of the next period dividend divided by the growth rate. Now, remember the formula. The formula, it goes like this. D1, D subscript 1, R minus G. That's the formula. Okay, let's see which one does it fit. Is it the present value of the next period dividend? No. So the present value of the next period dividend is D1 divided 1 plus R. Is this the formula? No. This is A. A is the present value of the next period dividend. No, the next period dividend, this is the formula for the next period dividend. This is not the same formula as this. You are discounting the next period dividend. That's incorrect. B, the present value, let's look at D first. let's look at D. D says the present value of the next period dividend divided by the growth rate. Is this correct? So what D is saying, it's D1 divided by G. Is this the case? No, the formula is not. C, the present value of the next period dividend divided by the required rate of return. It's D1 divided by R. Is this correct? No, it's not. It's not correct. So B, it says the present value of all future dividend, and the answer is yes. The price of the stock, whether it's the constant growth model or the constant dividend, it's the present value of all future dividend. Now, for the constant growth model, this formula here reflects the present value of all future dividend. But remember, the problem with all future dividend and the constant growth, you have to integrate G, you have to integrate the growth. That's why the formula is D1 divided by R minus G. Therefore, the answer is B. The present value of all future dividend is how you find out the value of a stock, whether it's constant dividend or constant growth dividend, whether it's zero growth or constant growth. The present value of all future dividend. This statement is extremely important. What should you do now? You want to go to Farhat lectures, look at additional resources, multiple choice additional lectures that will help you, whether you are in accounting, finance, CPA, CMA, CFA, whatever you are doing, invest in yourself. You need to grow. That's the best investment you can make. Good luck and study hard.